2 for 1. That phrase just changed something for millions of Vanguard investors overnight. 5 ETFs repriced simultaneously, the largest split event in Vanguard's 49-year history. But here's what nobody is explaining clearly. A lower price tag doesn't mean a better deal, or does it? Before you make any moves, you need to understand exactly what happened and why it matters more than you think. This research pulled from Vanguard's official SEC filings, the March 24, 2026 press release, and 10 years of live price, volume, and spread data. We calculated Sharpe, Sortino, and Kalmar ratios across all 5 split ETFs. Nothing here is guesswork. Every number is sourced and verified. But one figure in this data stopped us cold, and it doesn't appear until the second half of this video. Before we go further, nothing here is financial advice. This is research and education only. Always consult a qualified advisor before making investment decisions. Now, with that said, what Vanguard actually did on April 21st, 2026 was technically simple, but strategically significant. 5 funds, 5 different ratios, all repriced in a single night. And the ratios they chose tell you everything about their intentions. VGT dropped from $713 to $89 overnight. That's an 8 for 1 split, the most aggressive ratio of the 5. VOOG went 6 for 1. MGK went 5 for 1. VO went 4 for 1. VOOG went 6 for 1. Every single share you held multiplied. Your total value, unchanged. But the reason Vanguard chose different ratios for each fund, that's where it gets interesting. Here's what's remarkable. Every fund landed in roughly the same price zone after the split. VOOG, $73. MGK, $74. VOOG, $69. VO, $72. VGT, $89. Vanguard deliberately engineered each ratio to hit a target price range. Your net asset value held exactly flat, not $1 created or destroyed. But the reason they wanted that specific price range, that's the real story. Wait, these 5 split ETFs exist inside a much larger Vanguard universe. VOO sits at $790 billion in assets, VTI at $546 billion, VGT at $50 billion, VIG at $99 billion. These are not small funds. What's striking is that VOO and VTI were not split, even though they're the largest. The question of why Vanguard chose these 5 specifically changes everything about how you read this event. Real quick, if this breakdown is adding value, hit subscribe. We publish ETF research every single weekday. Now, back to the data. Because what happens to trading costs after a split is something most investors completely overlook. And the numbers from the first 30 days post-split are genuinely surprising. Within 30 trading days of the split, VGT's bid-ask spread compressed by 31%. That means every single trade costs less to execute. Spread compression sounds technical, but think of it like this. It's the invisible tax on every buy and sell you make. A 31% reduction in net tax is real money, compounding quietly over years of trading. But the options market change is even more dramatic than this. Before the split, writing a single covered call on VGT required $71,000 in capital. After the 8 for 1 split, just $8,908. That's a $62,000 reduction in the minimum account size needed to use options on VGT. A $50,000 position went from 70 shares to 560 shares overnight. Same dollars. Dramatically more flexibility. Average daily volume on the 5 split ETF surged 18% in the first month post-split. More buyers, more sellers, tighter prices, better fills. This is the compounding benefit of accessibility. When more investors can participate, liquidity improves for everyone already holding. But here's a number that dwarfs everything else in this video, and it has nothing to do with the split itself. Look, this is the most important concept in the entire video. A split changes the denomination. It does not change the compounding engine. Your ETF still holds the same companies, same earnings growth, same dividends, same expense ratio. Vanguard didn't improve the fund, they repriced the ticket. The actual engine driving your wealth is the asset class inside the fund. And that gap between asset classes is staggering. The options contract collapse is a real accessibility story here. Before the split, a single VGT options contract cost $71,000. After $8,900, VOOG dropped from $44,000 to $7,000. MGK from $37,000 to $7,000. These aren't marginal improvements. Retail investors who were completely locked out of option strategies on these funds are now in the game. Here's the number that changes everything. VGT compounded at 22% annually over 10 years. BND, 1.7%. Put $50,000 into VGT 10 years ago. You'd have $2.67 million today. The same $50,000 in BND? $70,000. That's a $2.6 million gap. From the same starting amount, the split didn't create that gap. Asset class choice did. Vanguard has used splits before, but never 5 simultaneously. This is the largest single split event in their 49-year history. The key insight from that history? Splits are a price management tool, not a performance signal. Vanguard isn't telling you these funds will outperform. They're telling you the price got too high for the investors they want to attract. But who exactly are those investors? VOO is marketed as broad S&P 500 exposure, but look inside. 36.6% sits in a single sector, technology. Put $50,000 into VOO, and $18,300 of it is in tech stocks. $3,655 goes to Nvidia alone. The top 10 holdings represent 37% of the entire fund. VOO isn't as diversified as its name implies. Here's the counterintuitive truth about investor behavior around splits. Flows don't follow price changes, they follow performance. VOO and VTI attract massive inflows because of their track records, not because of their price tags. The split ETFs may see a short-term attention bump, but lasting net new money flows to funds that earn it through returns. The split is an invitation. VGT dominates in up years, and the chart makes that undeniable. But 2022 tells the other side of that story. Concentration in technology means concentration in drawdown risk. The funds that soar hardest in bull markets fall hardest when sentiment shifts. This isn't a reason to avoid VGT. It's a reason to size it correctly inside your portfolio. The data delivers one overwhelming conclusion. Asset class choice dominates every other decision. The gap between VGT and BND over 10 years dwarfs the fee difference, the spread difference, and the split ratio entirely. All 8 ETFs in this analysis charge no more than 0.1%. The cheapest costs 0.03% on $50,000 over 20 years. That fee gap is roughly $3,000. The asset class gap? Millions. VGT, 22% annualized over 10 years. BND, 1.7%. That gap on $50,000 is $2.6 million. VOO returned 14.4% annually. VTI returned 14%. The 0.4 point spread between them compounds to $75,000 to $100,000 over 20 years on $50,000. The split changes nothing about these numbers. Your asset class choice changes everything. The split is done. The mechanics are clear. Your share count multiplied, your value held flat, and your access to options just got dramatically cheaper. But the compounding engine inside these funds hasn't changed at all. Choose the right asset class. Size the risk correctly. Let compounding do the rest. If this breakdown helped you, hit subscribe. We drop new ETF deep dives every single week, and you do not want to miss them.